All right. Hi, Jeff.
Hey, how's it going, Lindsay?
Hi there. Thank you so much for being willing to hop on a video conference call with me today and letting me interview you on behalf of the Mirabella ASU founding members. I know that you're a busy guy, so having access to information and expertise from you is really valuable to us all right now. So thank you for making the time.
No problem.
So we've got several questions that we received from founding members, but before I ask you those questions, maybe for those who haven't had the chance to meet you, maybe you could share a little bit about yourself and your background and maybe a little bit about the work that you do at ASU.
Sure. Well, thanks for having me. I look forward to getting to meet some of the residents in the future, and I think over time, hopefully we can connect them with thought leadership across the university and with some of our financial partners like BlackRock and others, hopefully under better conditions. But so I'm the Chief Investment Officer over at ASU Enterprise Partners, which means that my team oversees all of the foundation's investment pools, which would include the endowment, our sustainable investing pool, and then our short-term operating funds. I am an Arizona native. I went to high school over at Horizon High School in North Scottsdale. I went to ASU back in the day. I like to say that I was a Barrett student before it was Barrett, and WP Carey before it was WP Carey. I came back to ASU about 3 years ago. Before then, I had led the money management arm of a big broker dealer, where we saw about $5 billion of assets for clients. I live up in North Scottsdale. I've got a brood of kids. One of my girls is going to be attending ASU in the fall, so that'll be fun. And then
great news.
I've got a couple over at Chaparral High School as well.
Great. Well, thank you so much for that intro. So just to kind of get us started from a stock market perspective, can you talk about where we are with respect to the fallout from the coronavirus, and then how did we get here? What happened from a couple months ago to now?
Sure. So I think this was an interesting time. I mean, we started off with a health crisis, which became an economic crisis, which then turned into a liquidity crisis, which endangered becoming a bankruptcy default crisis. So you think back, in mid-January, I started to see a couple investment researchers starting to talk about things in China, and this coronavirus was maybe a little bit worse than people were thinking, but the markets powered on. Towards the end of January, Apple actually came out and said that because of shutdowns in China, it was actually going to affect their supply chain and was going to affect some of their earnings. But again, markets powered on. It really wasn't until February 19th, which is when the stock market hit its all-time high, when we started to get some fears of the virus spreading from cruise ships, that I think the stock market finally took note. And then from there, we got into this downward cycle of negative headline after negative headline as markets went down. In the midst of that crisis, we ended up with a oil war as Saudi Arabia and Russia went to battle trying to push out the American producer, which exacerbated things as we saw crude oil fall, all the way down to below 20. We'll talk about crude in a little bit as it's happened recently. But in light of all that, we saw both the central bank, the Federal Reserve, as well as the government, bring out the bazooka, so to speak, where pretty much every playbook they had, they brought out in a huge terms. I heard an interview with former Fed Chairman Ben Bernanke, and he said that they basically took the book that he wrote and ran with it in an unprecedented amount of time. So things that took years during the great financial crisis to figure out and roll out, were done in a matter of days during this time. So we saw, first the Fed cut the Fed funds rate in an emergency meeting by 50 basis points at the beginning of March. Then they announced they were going to start buying commercial paper, trying to bring some liquidity into the market. That's short-term corporate debt. Then as they saw challenges in the money markets, they helped out there. We saw troubles in the muni market, and the Fed helped out there. Then finally we got the passing of the CARES Act, which was $2 trillion of stimulus from the government, which is really when the market started to bottom then, kind of at the end of March, where I think there was finally some relief that the government wasn't going to let this continue to have bigger economic terms than it seemed like. And by the end of the day, we saw probably about $6 trillion of liquidity all told between the Fed and the government step in, which had again, a calming effect on markets. So I think where we went to, from the top to the bottom, we fell about 34%. It's interesting is that took 19 days, the fastest bear market that we've ever seen. The next fastest we've ever seen was back in 1896. We had a bear market, which is a 20% decline, took 36 days. So, 1896, for some context, that was when ASU was still known as the normal school. And it was actually the year that we adopted gold as one of our official colors. Still hadn't picked maroon, but the gold was picked as an official color. So I think, the real challenge then is that there's still a lot unknown, and markets are a discounting mechanism. And so they really didn't know where to price things. And that's why I think we saw that precipitous fall. Since then, some of that fear is left, and we're actually up 28%, technically, although I wouldn't count it, the start of a new bull market. Again, we had the fastest bear market followed by the fastest bull market in history. But, I think we've never seen before this type of unprecedented, coordinated action by central banks and governments across the world, right? I mean, I mentioned what our government and central bank did, but you saw similar action all across the globe in stimulus. So I think the conventional wisdom right now is that, this might take a little while, and we don't know what's going to happen, but as we get out of the health crisis, there's all the stimulus there that's waiting that can, kind of help propel things as we get into the end of the year. And so that's kind of our base case right now.
Got it. So very, very fast changes. That's maybe the disorienting part, is everything is happening so quickly.
Exactly.
So these are extraordinary market conditions. So what are you doing as, the in terms of your endowment strategy for ASU? What steps are you taking?
Sure. So, the endowment at ASU, we're about $920 million as of the end of the fiscal year of endowment. Which sounds like a lot of money, but it's actually a fairly small endowment considering how big ASU is. But our objective is a little bit different than maybe you or me or some of our residents would have in our personal or retirement accounts. We're trying to think about how do we pay out a real or inflation adjusted 4%, give or take, every year in perpetuity. And so that means that we're going to design our portfolio a little bit differently than maybe some, than we would do individually. That perpetual time horizon gives us some benefits, though. We've got a long-term time horizon, and as we try to balance the desire to grow with the need to be stable, we end up with a pretty sophisticated, more institutional asset allocation in our portfolio. So where we invest tends to be both in stocks and bonds, like a lot of people have, but then a lot of private markets things like real estate, and private equity and hedge funds as well. Our target is to be about half and half in the portfolio. What's interesting, the residents might like to know, within that 20% of fixed income, that blue slice there in the middle, we actually hold a big chunk of the Mirabella bonds that are helping with the construction costs of the project. So we've got a vested interest in the project within the endowment as well. But really our strategy is about broad diversification. We're looking with our long time horizon to be diversified. We look for cost efficient vehicles. We try to find some additive performance by finding active managers that can beat their benchmark. And we try to be nimble and tactical when it's appropriate. What we saw in February, March is that portfolio construction ended up meaning a lot more than security selection. So in other words, it didn't matter, which stocks you owned. It was really about, where you had allocated your money. And one of the things that we have unique is we actually have more bonds than most of our peers. At 20%, we're on the high end. Most of our peers have been taking that down, but we actually increased it. And so that really helped us in our portfolio. And I think that's probably similar to what, individual investors saw as well, is bonds were that ballast that helped them out. Typically these big periods of volatility provide dislocations that we want to take advantage of. One of the things that we've noticed is that in prior bear markets, oftentimes coming out of it, you can earn equity-like returns in safer places. So you don't need to be in stocks to get, those double-digit returns over time. You can be in things like high-yield bonds and investment-grade credit on that side. So we've been shifting some capital that way to try to take advantage of these things. And I think what these periods tell us is really helping understand what our sensitivity is for risk. In my past world, when I was dealing with a lot of individual clients, oftentimes it's easy to reflect after you've felt the pain. And I think, that's not necessarily the time to be making adjustments, but it is time to kind of understand, okay, am I where I want to be? This was clearly historic, but seeing a decline of 30%, in the stock market is not unheard of. So, if that was maybe more losses than somebody wanted to endure, again, we've come back a lot. But I think that would be a good signal that when things settle down, maybe it's time to get a little bit more conservative. We build our endowment for resilience. So we were down 7 or 8% in March. So we really didn't experience huge losses, and we've made some of that back. But beyond some of the things in the credit market side, we don't envision doing a whole lot else because we like where we are. There's some things on value stocks where we're less in those and more in growth names, more technology. We've made some shifts like that, but by and large, we haven't made any big shifts because we like kind of where our portfolio has been structured.
Okay, thank you. We've got a few residents who have questions around the book, The Black Swan. And in the book, there's a discussion about the positive and negative black swan events. This economic collapse is an obvious negative black swan event. And the question is, what mechanism do you use to protect your portfolio against ravages caused by black swan events, such as current pandemic?
Sure, it's a good question. I saw an interview with Nicholas Taleb, who's actually the author of the book, and he actually said that he doesn't think of this as a black swan event.
Really?
Now, I hate to disagree with the guy who literally wrote the book on the topic, but I think his point is that there'd been a lot of concern about pandemics, and obviously we saw with SARS in the past and some of the other outbreaks that a pandemic is not outside the norm. I think what nobody would have anticipated is, again, the global shutdown that we saw as a result of it. So maybe the cause was not unknown. I think the response and then the impact was an unknown. So I would characterize this as a black swan, even though maybe he didn't. With that said, the biggest hedge in our portfolio has been long-term treasury bonds. So typically in periods of volatility, you have a run and safe haven assets. So people go to the safest thing, and treasury bonds, the so-called risk-free bonds, are that. That tends to get coupled with thoughts that the economy is going to slow down, and that there might be a recession. And when that happens, interest rates come down. And when interest rates go down, bond prices go up. So typically, treasury bonds can be a really good hedge in these big periods of volatility. That's also what we saw during the Great Financial Crisis and other bear market periods. So that's been a really good stabilizer in our portfolio. We also, in our hedge fund portfolio, have some strategies that can short the market through futures. Those can make money again when markets are going down. And then we have some strategies that really try to capitalize on volatility. So again, those are doing well in a market like this. And then typically, not in our portfolio, but others think about things like gold as another safe haven asset, which can go up in value when fear is high as a store of value. And then we don't have it as well, but you hear about other players that have these so-called tail strategies. Basically levered strategies that might lose money in most environments, but when the markets do what they did lately, can go up 100%, 200%, 300%. Funny, I heard that CalPERS, the big pension over in California, had just gotten rid of all these big tail hedges in their portfolio in February. So it's bad timing to get rid of insurance right before. Yeah, but so we don't necessarily have that in our portfolio, but that is a strategy that others might employ as well. So we tend to rely on bonds and again portfolio diversification, which I think probably something that most of our residents can take true to heart as well.
Okay. Now, some of what you just said probably covers the next question, but I will say it, I'll repeat it so that we make sure that we cover all the questions we got from founding members. On the topic of black swans, one recommendation in the book is that funds that are absolutely necessary be completely hedged. It appears that traditional thinking of diversified portfolios that become more conservative over time may need to be modified by adding hedging positions. What lessons learned from the current situation should be applied to investment portfolio planning for those who are early in their careers that will assure retirement income will weather black swan events over time and be available when needed?
Yeah, I mean, again, I think beyond the portfolio construction, talk about some hedges. I think ultimately it really comes down to time horizon. So, I think rather than thinking about money that we need to hedge, I think it's really more about money that we might need in the short term. We need to have liquid and safe. So if we have expenses that we know are coming up in the next 1, 2, 3 years, that's probably stuff that's money that shouldn't be in the market, because again, you can see lots of volatility there. With longer time horizons, though, I think what we see is that that time in some ways forgives all wounds. This is some research that I saw that I thought was interesting, but just looking at what a typical 60 stock 40 bond portfolio has done in these other crisis periods, and where in the short term, maybe a year out, a lot of times you're still negative. The longer the time horizon, 3 years, 5 years, if you look at all these prior shocks, a standard portfolio is going to turn out okay. So again, as long as you've got the time to persist, I think hedging is less of an issue with a diversified portfolio. But again, I think the lesson that we learned here is that that liquidity is important, and money that you might need should be held in a safe place. And I think the challenge that retirees have oftentimes is this balance of eating well and sleeping well. Sometimes the capacity to take risk is different than the willingness to take risk, and so I think that's an important self-awareness or reflective thing to think about is the more income you need to drive from your portfolio, probably the less ability you have to take risk, because you need to have that last for a while. The more money you have, maybe the less need you have to take risk, but the more ability you have to take it. So it's kind of all that balance of what's right as well as what can help you sleep at night.
So time for reflection. So the next question is sort of, it sounds like a personal scenario. My husband and I started to explore the option of moving into Mirabella at ASU approximately 4 years ago, when the Dow Jones average was between 16 to 17,000. Even after the COVID crash, it's now higher today, approximately 23,000 than it was when we first started the discussion to move. And we have enjoyed many years of nice stock dividends. Nevertheless, our planned move feels like a more perilous decision in the current economic environment than it did when we first started to decide to transition to Mirabella. Is there a level of market volatility that we should be considering as well? And what are your thoughts on why we are feeling things are less favorable than they were before? Two-part question.
Sure. No, I mean, I think that's always the $1 million question. I think this, as I mentioned, has been a historic move, and sometimes that's scary. But from a longer term perspective, again, if this is looking at the Dow, where we are currently, right around 24,000, is a level that we had seen back in October of 2019, and then again in January 2019, and again in October of 2017. So we've wiped out a little bit of gains, but if you think about it from a 4 or 5 year perspective, we're still way up. So from a longer term perspective, again, this wasn't fun because it was so quick, but it's still in a longer term sense is still kind of within the norm of what we see. And I think it's natural to feel some angst. This chart is looking at a measure of economic uncertainty, and when and this is based on survey data and some other economic metrics, but when you put it in perspective, this is again unprecedented. You think about everything we've lived through in the modern generation, and from this metric, the uncertainty, the level of uncertainty is higher than we've seen before. So, you know, again, I think that anxiety is normal, and in some ways it's going to take time for us to work out of some of these things. You know, and this is one metric. You know, we could look at VIX, which is another measure of volatility. Some of the magnitudes of other things that we've seen, but the long term, you know, there's going to be ramifications from what we see. You know, we're already starting to talk about the supply chain. You know, the fact that we're so dependent on China for, you know, PPEs and other things like that, and kind of the importance of having some homegrown stock of things like that. You know, it makes us think about that. Part of the spread, you know, had to do with how globalized the world is, and you could imagine some changes happening there. Obviously, the effects on travel, education in our sector. You know, what's this gonna look like in the fall with school? What's it gonna look like for sporting events? You know, working from home and the dynamics of there. You know, I'm working from home like most people, and you know, there's pros and cons that go along with that, and lots of companies that never thought of it before have now had to get used to it, and that's going to have effects on office space and all sorts of other things. So, you know, I think it's a reflective time. You know, this has exacerbated some of the socioeconomic challenges we've had. If you look at, you know, the people that can work from home versus people that can't, you look at, you know, the educational side of you know, who got access to Wi-Fi and who got access to laptops for their kids to work from home or do school from home. You know, these are all things that we're going to be contending with for a while. So again, there's uncertainty there, but that doesn't mean that there's not hope. You know, I think we like to say it's darkest before the dawn. This is just, again, some interesting, I think, some market stats. So the chart on the left is showing the percentile. So basically, kind of where do we rank based on our trailing 1 year, 2 year, 3 year, 5 year, and 20-year returns of the market. So if you think about, you know, the last 20 years, we've had the dot-com burst, the great financial crisis, and now COVID. So we've had 3 bear markets in 20 years, which means that our return is very low. So 96% of history has seen a higher 20-year return than we've seen currently. So if you think about mean reversion, you know, if we're really low on a trailing basis, what might we see in the future? You know, since returns are really low right now, you know, we might expect the next chapter to be a little bit above average. And you see that we're kind of below average on almost every trailing return perspective. So I think that's some hope once we get out of this. Chart on the right was an interesting one too. Again, the magnitude of this move is unusual, but we saw a 20% decline in the first quarter of 2020. You can see that in the gray box there at the bottom. And there's only been a handful of other times in history where we've seen more than a 15% drop in a single quarter. But again, when you look forward from those periods, the returns have actually been really good. The next quarter has been positive, you know, almost 90% of the time. The next 2 quarters have been positive 100% of the time, and the next year has been positive almost all the time as well. So again, we've already seen a pretty good recovery so far in April, which I think is good. But you know, I guess I'd say I'm sympathetic. I mean, we're all dealing with somewhat the shock of it all. I mean, yesterday in crude markets, if you'd seen the news, you know, the price of crude oil dropped to negative $40 a barrel. You know, we were joking about converting the ASU swim facility, Mona Plummer, into a holding facility for crude. We figured out we could hold, you know, 24,000 barrels of crude oil in the Olympic size pool.
You did the math.
And arbitrage that. Yeah, exactly. So, you know, it's just shocking what we've seen. But again, I think, again, with a longer time horizon, you know, we're going to get through this.
I think you said it. It's the quickness of it and what it exposed is sort of the shocking part. But that doesn't have any bearing on whether there's cause to hope or whether there's evidence to hope that things will sort of continue. So last question. So what are you keeping an eye on to see if risks are falling, and then what would you expect to see in the months ahead? Sure.
So, you know, in the shorter term, you know, the economic data is so absurd that it's almost unanalyzable, right? I mean, we've had, you know, 3 different prints on jobless claims that were, you know, 5x the highest we've ever seen in history.
Right.
And interestingly, the market went up on each of those days, right? So the economic data is almost meaningless right now. And companies we're in earnings season right now, but companies aren't issuing guidance. So, the traditional economic and fundamental things are really have no meaning right now in an analysis time. So I think we're going to continue to see markets in the short term led by the health side. So, evidence of the curve flattening, more evidence about immunity, post-infection or in the presence of antibodies. There's some talk about weather sensitivity. There is a study out now about the effect of sunlight on the coronavirus. So as that gets more and more proven, then we get into successful treatments and therapies and progress on the vaccine. So I think those are going to be things that really move the markets in the short term. And then similarly, the policy side. So, we had run through a lot of the small business funding and making progress on another wave of stimulus. So I think in the short term, it's going to be health and policy driven that really drive the market more than anything that we can analyze. In the intermediate term, we're looking more for things to stabilize. Volatility, VIX is a volatility index that went from 10 to 80. So it's around 40 right now. So looking for that to kind of return to the 20s and 30s would be a positive sign. We look at credit spreads, which is the difference between what a corporate bond pays versus what a treasury bond pays. There's a lot of talk a couple weeks ago. Carnival had to raise debt at a 12% yield. If you think about treasuries at less than 1%, that's a big spread. Oh. So as that spread comes down, that's going to be a sign that the markets are thawing. And then as you see the flight to quality start to unwind, so people piled into the US dollar, into treasury bonds, into gold. So as some of those things start to stabilize, that'll be a positive sign that we're coming out of this. And then finally, looking at what we call kind of our pandemic portfolio, or some of these stocks that you've heard that have done really well, the staples and the work from home names. So as you start to see performance of those start to lag the broader market, again, I think that'll be a sign that people are less concerned with what's going on. And then longer term, then we start to get to the point where we're starting to really look more at the fundamentals again. So you'll start to get a sense of the shape of this economic recovery. You've heard every letter. So is this going to be a V or a U or a W? People are thinking of the Nike swoosh. That's probably the sign, which is kind of more of a growth, but slower on the long end. But I think as we get into the second half of the year, the fundamentals return as being what matters. How is the economic data looking? How are the companies' earnings looking? And that's going to be what ultimately is going to have to carry the day. Until hopefully we get the actual vaccine into next year. So there's a lot we're watching, and again, I think a lot of it is going to be more policy and health related in the short term because the economic data is so ludicrous right now.
Great to know. There's a lot of things to watch out for. Well, thank you. This was really valuable to us. I know we took up a lot of your time, so I'm going to let you go. But thank you so much, and really appreciate you visiting with us. Hope you'll visit us again.
Yeah, stay safe, take care, and hope to talk soon.
Will do. Take care. Bye-bye now.